So let's look at strategies for buying puts, writing naked puts, and writing covered puts. Customers will buy puts when they want to speculate in a bearish market. You believe that the value of a stock is about to go down, and normally when people think the price of a stock is about to go down, they would sell short. But when you sell short, you run the risk of getting a margin call if the price of the stock goes up. When you buy a put, you can profit when the stock goes down, and if the stock goes up, you will only lose the premium you paid to hold the put. The second reason an investor would buy a put is to protect the profits on a long stock position. This is known as a protected put or a mirror put. Let's look at an example. You bought the stock at 20 and it's risen up to $75 per share. And it's kind of high, so you're concerned that the price of the stock may drop, so you go and buy a put with a $75 strike price. If your worst fears come true and the price of the stock does drop, every dollar that you lose on the long stock position that you hold, you'll make back on owning the put. If the price of the stock goes up, you'll have a potential unlimited upside gain on the long stock position that you already own, and all you'll lose on the put is the premium that you paid, and you won't exercise the put. People write uncovered puts to speculate in a bullish market. In this case, they write the put to take in the premium, and they hope that the market goes up so that the put will not be exercised, and they will get to keep the premium they received for selling the put. Writing a put is an income strategy. The customer hopes that the put will expire, and he or she will get to keep the premium they received, which will enhance the return on the stock position. So let's summarize all four types of put positions that we have looked at. The buyer or holder of a put is bearish on the market. They believe that the market is going to go down. The maximum possible gain occurs when the price of the stock goes to zero, because the holder can sell the stock at the strike price when it is worthless. The holder's maximum possible loss is the premium paid for the options contract, and the holder of a put's break-even point is the strike price minus the premium, right? The strike price minus the premium. The writer of an uncovered put is bullish on the market. He or she wants the market to go up so that the option will not be exercised. The maximum possible gain is the total premium received. The maximum possible loss for a holder occurs when the price of the stock goes down to zero, because if the option is exercised, the writer has to buy the stock at the strike price when the stock is worth nothing. And the break-even point for the writer of a naked put is the strike price minus the premium. The writer of a covered put consists of two positions, being short the stock and the writer of a put. The customer does this in theory to protect themselves from losses on the options contract in theory. What is the writer of a covered put's market outlook or maximum possible gain? Well, the writer of a put hopes that the market goes up, and their max gain is the premium received. The max loss is unlimited for the writer of a put because the customer has used a short stock position to protect the put he or she has written, and a short stock position faces an unlimited potential loss. And what is the break-even point for the writer of a covered put? Remember that the writer has received the premium. When will the writer of a covered put lose the premium? They will lose that premium when the short sale price goes up. It is the short sale price of the stock plus the premium received. And finally, let's look at a protected put, which consists of two positions. A customer is long the stock and long a put. They bought a stock and they bought the put. What is the maximum possible gain? Unlimited, because the customer is long the stock and the stock could rise infinitely. What is the customer's maximum potential loss? Typically, it's the premium paid to buy the put. What is the break-even point for the protected put? Remember that a customer has paid out a premium to buy this put. When will the customer make back this money on a long stock position? When the market goes up. So it's the purchase price of a long stock position plus the premium